Welcome, everyone, to today's panel discussion titled Liquidity Management, Pain Points, and Leverage. This is Brian from Strategic Treasurer, and we're pleased you could join us as we discuss corporate pain points, developments in the economy at large, and the use of levers such as supply chain finance to better manage liquidity. Our moderator for today is Craig Jeffrey, founder and managing partner of Strategic Treasurer. And our panelists are Ken Akel, CFO at Optimum Healthcare IT, Boaz Rahav, co-founder and CFO at Hypersonic Force, and Terry Ragsdale, CFO at LSQ. Welcome, Ken, Boaz, Terry, and Craig, and I'll now turn the presentation over to you.
Thanks so much, Brian, for the intro, and welcome, everyone. Thank you for joining us on this discussion, a panel discussion. Very light on the slides, so we appreciate everyone's engagement in the chat box and the Q&A box. We've got a good panel, very experienced, intelligent people. We'll have a good conversation as we step through today's discussion. But just as a way of getting a little bit more information from everybody, let's go do some introductions. So let's go in the order that I had suggested before. And just give us a little bit about what your responsibilities are so you have a little more color.
My name is Boaz Rahav, and thanks Craig and Terry for hosting today's event. Topic is super exciting and interesting and timely. I am the co-founder and CFO of Hypersonic Force, based out of Florida. And we are a prime contractor to the Department of Defense. We specialize in hard to find and hard to source commercial items that might be available worldwide. And that's what we do. As part of my responsibility, I'm in charge of making sure that the machine works. We have quite a lot of transactions, POs, ARs out there, and my job is to make sure that things are working as smoothly as possible, especially in light of changing environment as we have today.
Great, thank you, Boaz. And Ken, how about you jump in?
Yeah, thanks, Craig. Hello, everyone. My name is Ken Akel. I'm with a company called Optimum Healthcare IT. So we are a full-service IT staffing and consulting firm. We're located in Jacksonville Beach, Florida. And we work with large hospital systems all throughout the country and some internationally as well. So we like to think of ourselves as sort of the one-stop shop for the chief information officer at hospitals. So whatever their problem is, whether it's a workforce solution problem or a full-scale IT project that they need help with, an implementation or go live, we're there to solve that problem for them. So my job encompasses really, everything that you would think of in accounting and finance. So heavy on the treasury and cash flow management, as well as, projections and FP&A and what you would think of as traditional accounting. So happy to be on this webinar with everybody.
Excellent. Thanks, Ken. And Terry, are you also from Florida? I didn't realize we were having a panel that's at least half Floridians.
Well, yes and no. LSQ is located in Orlando, but I'm located in Philadelphia. We have about 100 people in Orlando and then 30 or 40 of us in various areas around the country. So I'll go on from there. LSQ is in the working capital finance business. We're kind of in the business of bridging the gap that, buyers want their payment terms to be as long as possible. Suppliers want payment terms to be as short as possible. And so we try to help one element of that or the other or both and bridge that gap. We've been around for about 25 years doing that. I am the CFO, and I think I would just describe my responsibilities as being quite similar to Ken's, just at a different company. And I've been around LSQ for about 10 years.
Great, thanks for the intros. And just for everybody who's either live on the internet or live through Zoom, I think we're on LinkedIn Live and Zoom, pushing out to both channels. What we're going to cover today, as we talked about the topic of liquidity management, what are the pain points, as well as how do we engage leverage. We're going to cover a little bit on the current environment. What are we seeing in the area of liquidity? We'll look at the pain points then next. We'll look at what are some of the developments in the economy and how is this bothering the markets, bothering our customers or suppliers. then we'll look at levers to manage liquidity, and then we'll wrap up with final thoughts. So, Terry, I'm going to begin with you and then have Boaz jump in. As we look at the current environment, what are some of the headlines that you would describe for the current environment for liquidity management? I mean, that most people are, certainly aware of some of the major items that have been occurring, but maybe give some calibration on that for the audience.
Sure. I think the one-liner is it's just a radically different world, liquidity these days than it was 18 or even 12 months ago. It's not very long ago, I think we all would have said that the world was awash in liquidity, in cheap money, and that was the case for 15 or so years, starting with the financial crisis in 07, 09. Rates were extremely low for a very long period of time. Rates even bordered on zero for the financially strongest borrowers, the investment-grade borrowers. And capital was just an undifferentiated commodity with lenders falling all over each other to offer it. So I think liquidity wasn't at the top of the list for those of us on this panel and probably those in the audience here. There's some pretty experienced financial people these days who have literally never lived through any environment other than low rates. And even those of us who have lived through it probably would plead guilty to having grown maybe overly accustomed to persistently low rates. But the Fed obviously has changed that situation dramatically. And I guess I would say there's two obvious impacts to that. One is some borrowers have seen a doubling or tripling or worse of their interest payment burden. And then secondly, some banks have lost deposits or have to pay a whole lot more than the former zero to keep the ones they are keeping. So their credit appetite is significantly curbed. So today, capital just isn't cheap or plentiful anymore. And so it's more at the top of the list. And I think CFOs and treasurers are looking for creative ways to manage their liquidity that maybe aren't as simple as a bank credit line.
Creative, not in terms of creative accounting, but creative ways of finding other sources of capital. Sure. No, that's good. I mean, yeah, the shift has been so dramatic with the rise of inflation and the Fed moving, particularly the Fed moving rapidly to address that with so many large rate increases. In 1 year, what a change that's been, and how that's rippled through the markets. Certainly, Boaz, anything you wanted to add to the dialogue about the current environment that we're experiencing?
Sure. I definitely echoing on what Terry mentioned. It's a completely different landscape in a universe that we all facing on different directions. It's in a strange way, it's back to the new normal, but it has been unnormal for so long that everybody kind of forget how the new normal looks like. And it requires adjustment after 13, 14 years of irrational exuberance and zero interest rates. It's you need to sharpen your pencil and rethink liquidity, risk, assessing risks, and from places that sometimes you don't, you forgot that some risk may be buried somewhere, but now they start to emerge. At Hypersonic, we are in a unique place because our customers are different branches of the Department of Defense, maybe Navy or Army or Air Force. So our ARs are pretty stable. We don't see any changes there. The payment terms are fixed, didn't change forever. Thank God the government is paying on time. So for us, AR is not a concern. On the AP side, the other side of the equation, the market did change a lot. So we fulfill government orders by buying merchandise from hundreds of vendors, mostly in the US and around the world. And the way we assess that has changed dramatically, from assessing risk profile to negotiating deposits, to trying to really think through the cash flow process and forecasting and making sure we are not too overly optimistic, but at the same time, we can't be overly pessimistic because we have to run a business. So coming back to the new normal takes time to adjust. We are fortunate to have actually LSQ as a funding partner, and we work together in assessing risk, and it's a great journey for us. But at this point, the landscape has been changing quite a lot over the last 12 months. And I believe we all owe it to ourselves and to our companies that we work for to really take a deep look and really understanding the fundamentals and the way they are changing.
Yeah, excellent. Ken, anything that you wanted to add or comment? I know there's other news, the debt limit, the ceiling that appears to be moving towards conclusion. Anything else that you wanted to comment there from the environment perspective?
No, I mean, nothing significant. I mean, I think just uncertainty obviously, makes its waves throughout the markets and everyone feels it. And when everybody's nervous, things continue to get squeezed. So, as Terry and Boaz kind of referenced, we're all feeling that and have to come up with creative ways to, solve some of those constraints that we are running into.
Yeah, some of our research, when we look at views, perspectives on the balance of power between lenders and borrowers, what are the banks saying and what are the borrowers saying? It definitely in the last 3 periods, so over a 2-year period, measuring from 2 years ago to a year ago to current, the balance of power was to the lenders. They felt they had much more capacity to borrow. They were, the world was aflush with cash, and that shifted in these timeframes. So that was the same view, very similar view the bankers had as borrowers and corporate practitioners. As we move through a couple of periods, it's moved dramatically in the favor of the lender. There's feelings of limited, much more limited access to cash. And when you can get it, it's at a higher rate. It's not a terrible situation, but it's definitely more costly and less available than it was a year ago or 2 years ago. So in 2 years, what a difference it makes. There's a question from an attendee. What are the opinions on banks ceasing lines of credit? I don't know if anybody wants to take that. We don't have any particular bankers on the line, though that is happening. Anybody care to take that?
I'll jump in on that one quickly. As I mentioned, and as everybody has been reading post Silicon Valley Bank and other things, deposits are tending to move either from smaller banks to larger ones, or from zero yielding deposits at banks to something that yields, like a money market fund. As a result, banks are sitting on less cheap capital than they had grown accustomed to, and as a result, their appetite for credit is lower. I've seen situations recently where a bank was interested in extending credit, but only if the borrower would place deposits with the bank, which is a little counterintuitive from a liquidity perspective. Yes, thank you for lending me the money, and now here it is back, into the bank account. And I think some of the surveys, like yours, Craig, have indicated that banks genuinely are pulling in. They're pulling in terms of their interest in range of credit quality. They want higher quality. They want to concentrate more of their business with people they've been in business with for a while. And just in general, their funds are more expensive and less available, and therefore lines are harder to come by.
Yeah, let's get everybody involved with a poll question. We have some poll questions. This is particularly useful for those looking for CPE. But it's great for everybody just to see what the audience thinks on the topic. So Brian will pop up our first poll question. It could show up anywhere if you have multiple screens, or it might show up on your primary screen if you're only one screen. So this is about financial pressure. And we are experiencing more financial pressure from some of our trading partners, more pressure now than a year ago, with suppliers, buyers, both, or neither. So I'd love for you to answer those. This is a single choice. I know reality it can be, I guess you could select suppliers and buyers, but because we have both, just go ahead and select that. That will work well. And if neither of those are the case, go ahead and put that in there. Once you've hit submit, you've made your selection, hit submit. We invite you to go into the chat box and type the word SCF, that stands for supply chain financing, just as a way of linking it there to the topic at hand. If we have, say, 150 people type the word SCF, or type the letters SCF. If you type the word poll, we'll accept it too, but if you go ahead and type that in the chat box, we'll go ahead and send out the responses to everybody who attended today's session. Right. Brian, when it looks like we've got 2, 3, or 350 or more poll responses, go ahead and share that. Panelists, if you guys have any comments, pithy comments, we'll take them from them as soon as it shows up.
Yeah, I think looking at the, I'm not sure if everybody can see the results on my end. I can, I don't be kind of spoiling the news here, but it seems that most people feel that the answer both is the correct one. Almost half of the response came to both sides, which is really not surprising. When you have risk-off type of mentality, you feel the pressure on both sides. And as we said, the paradigm is changing, has been changing, not done yet, probably. And that's not surprising at all to see the effect on both sides of the equation.
I see 29% say neither. I guess that's maybe a little surprising to me. I thought potentially the other 3 categories would take a little more than that. But I mean, I think that's great. Almost a third really aren't experiencing pressure from either suppliers or buyers. So, or at least more than they're used to. So, maybe people are adjusting and things aren't quite as bad as they seem potentially. So anyways, just kind of, that was my initial thoughts.
I have the same reaction as Ken.
From a pain point perspective, as we think about pain points, this rapid shift has created pain. And we talked about less access to working capital throughout the cash conversion cycle or supply chain. In many ways, we've seen inflation, which has increased cost. And, this idea that I need to see what's going on, but that doesn't necessarily relieve the pressure. It lets me identify it earlier, which is helpful, but not enough. But maybe you could talk through some of the pain points or challenges you see with your customers, suppliers, or in the conversations that you're having with your peers.
Yeah, so I can talk to that. So in our business, given that we're in the consulting world, the good side is we don't have a ton of suppliers. Our asset is our people. So one of the biggest pain points we have is, we are, continually paying our people biweekly. Our consultants are traveling all across the country. Travel costs have increased. That cost gets passed on to our customers, but they're not always excited about that. Given that we are working with hospitals, a lot of hospitals notoriously are slower payers and have stretched payment terms. So in our business, we're performing work, let's just say for a project, let's just say monthly, or every week, we should say. And then, we're not maybe billing our customers until the end of the month. So we're floating that cost before we can even generate our receivable for roughly 30 days. And then with our payment terms, hospitals are anywhere from 30 to 60 days, kind of depending on what we negotiate with them. And as I alluded to earlier, some of them are slower payers and they take it a liberty upon themselves to kind of pay when they want to. So we don't always have a ton of visibility on when the cash is coming in, but we're continually, floating cash, every week. And so that gets amplified in times like this, specifically, as everyone I'm sure knows, hospitals have experienced a lot of stress in the past 3 years. And, more recently, with inflation and staffing shortages, currently nurses is the big trigger, right? So a lot of nurses have moved to the traveling nursing model. So they're not full-time employees of any one hospital. So that's a much more expensive model for hospitals. So hospitals' margins are being squeezed, their budgets are getting tighter. So you start to see a little bit of your organic growth slow down as hospitals are, pushing projects back or pushing back on our bill rates, really doing whatever they can to squeeze as much margin as they can get out of their business. So then you look at, when you do have the opportunity to land these larger projects, so continue to grow your business organically, right now you have to take a much deeper dive kind of into 2 things. So one is the credit strength and the financials of the customer you're accepting that project for. Because, 2 years ago, maybe it was a slam dunk, even if a customer had, marginal credit, you could withstand a potential, extremely extended receivable. But now we have to look a lot tighter into that. And so you risk turning down maybe a large project that could really, grow your top line revenue, but you're turning it down to not put the rest of the business at risk. And so, on the flip side of that, if you want to grow inorganically, which, a lot of companies are looking at, including ours, to grow, through bolt-on acquisitions, if you don't already have a lender, that's going to be a tough relationship to kind of forge today. We're lucky that we have strong relationships with some lenders, but once again, that money is now a lot more expensive today than it was, a year or 2 years ago. So now you're looking at it eating into your margins and your return on your capital, just because the cost of capital has increased so much in the last, couple of years. So, really for us, those are, I would say, the main pain points we feel. And so, we do a variety of things to mitigate some of that, which I think we'll get into later. But I would say for us, that's kind of the crux of it all.
That's a great start. Boaz, who would you like to add to that?
Sure. So I will take from what Ken mentioned, and I will take two items which are super relevant for us as well. One, I'm going to start with the second point that Ken made about relationships. Coming back to the same point of going back to the new normal, relationship count a lot. When money is there cheap, then liquidity is a commodity, is available. It's widely available. It doesn't require too much work. But when you go back to a different environment, relationships, long-term relationship, having that working history together and trust are becoming more and more relevant throughout the entire ecosystem. And that leads to the first point that I also will borrow from Ken with your permission. But I will reflect that not on the on our buyers, but actually on our suppliers, on our buyers. As I said, we are in an interesting business where our buyers are different government offices, so no worry there. But on the suppliers, we are seeing a shift where OEMs throughout the world, their cost of production is increasing by the week, by the month, just on the back of COVID, that create tremendous strain on the supply chain overall. Second, we see their request to pay higher deposits. It's a trend that we have seen for the last year. So OEMs that were cool with 10%, 15%, and then some scheduling of deliverable now require 30 or 40% just to place a PO, because they need to buy the goods to start production. It also, we see some of the contracts that, future contracts, delivery will take place in 3 months, 6 months, 9 months, just because the item needs to be produced. It is harder and harder for them to lock a price today, which is also an interesting phenomenon, because if I'm buying $1 million worth of an item to be delivered in first quarter of 2024, we see OEM kind of struggle how to price that. And that's also adds a little bit uncertainty and a little bit of a discussion and going back for forecasting and models to see what makes sense. And of course, on our end, we have a fixed contract by the government, and we need to think about long and hard whether there is enough profit coming to us in first quarter of 2024 that it's worth the while, especially when you need to pay higher deposit and you need to finance that spread, the time of production over an extended period of time. So again, going back to the new normal, we have done that before. We haven't done that. We didn't do that type of heavy thinking and deep thinking for quite a long time, and now we are going back to the drawing board.
Yeah, this rapid increase in the amount and the timing of these deposits, that doesn't fit into your regular model when you look at what was going to change a year ago to what's happening now with that environment. Quite a significant shift.
Gives new meaning to shorter payment terms, right?
Yeah, prepay everything. It's like buying your airline tickets, right? I want to place an order, send your money in, and then we'll source the material out of the ground, put it together, and then ship it to you. That's kind of a rough environment. Terry, I'm going to ask you to make some more comments on this if you want in the next section. I'm going to set up the next section, so feel free to tag team into that. Actually, if you have any comments on this, why don't you get going? Because I want to pop up the second polling question now. So let's let it pop up for a second.
Sure.
This is a select all that apply. On the macroeconomic outlook side, we have a moderate or higher concerns about the economic impact. You know, when we look back, maybe if we look back 6 months, 6 months to today, we have a moderate or high level of concerns about the economic impact. Not low level, not any, but just moderate to a high level of concerns. Russia's ongoing war against Ukraine, down to tightening access to capital and trading partners, or none of the above. So select all that apply and hit submit. Give everybody just a moment. After you hit submit, we'll let others respond there. If you've done that already, in the chat box, Brian has happily put up some ways to follow some of the companies on LinkedIn, LSQ, Strategic Treasurer, and then our media site, which is CTM File. And I am pleased to say that we have now hit the 150 people typing SCF. We've exceeded it. No more is needed. Everything else will just bank in our computer. So we're all set. No need to type more. Or keep typing it. That's awesome. Yeah, I see that for some people, the poll questions are not responding. The poll's not popping up for people, so apologize for that. Brian will probably pop some information in the chat box. So we're all good with the comments there. So concerns, top concern is inflation, followed by central bank interest rates built to combat that, and then closely followed by a global recession, and then resolution of the U.S. debt limit. I wonder how that would have answered a week ago, right? If that would have been up in the 70 or 80% range. Now it's suppressed quite a bit, just 4 out of 9 who responded are saying that. And then 2 others, tightening access to capital and Russia's war, sitting about 3 out of 10. That looks like a pretty perfect bell-shaped curve almost, right? Just peaks up with inflation sitting in the middle. Anybody have any comments on these responses or any other thoughts that we should look up?
Sure. If I may, the question was about moderate or higher concerns. So I will take it as most of the participants today, like everybody else, have a high level of concerns about quite a lot of items. So it's not a single problem that bothers us on a day-to-day basis, whether it's going to be a war or inflation, but it's all over. Yes, there are differences in distribution, but we just outlined 6 different concerns that people are bothered by, which is a lot. And that's my comment. So it's not a single one problem we have, a war, inflation, or the Fed, or whatever it's going to be, but it's across the board, and that's something to take home.
Yeah, and only 3% didn't identify any of those as moderate or higher. That's quite low. Any other comments on this one?
Well, it'd be interesting to see what people would type in as their additional issues they're concerned about. Maybe people can do that in the chat box. My other reaction is that the first 2, I mean, to your point, Craig, about resolution of the U.S. debt limit, maybe people having a different view a week ago. The first 2 strike me as kind of binary. That is, they're either going to be a big problem or they're not going to be a big problem, right? I mean, Ukraine maybe contributes to inflation and is sort of higher or lower, but it's kind of binary. The rest of them, it's sort of what the temperature is. Is it going to be a red hot problem, or is it going to be a moderate problem? Where is it going to end up, et cetera? And I do think that the market today is spending more time worrying about how high rates are going to go, whether we're going to have to go into recession in order to get inflation back to something manageable, and finally, how bad credit quality is going to get due to any combination of these factors.
Yeah, nothing was below 30%, and we didn't have anything hit the 75% response. Inflation was just under that. Thanks, everybody, for taking our second poll question. I'll go back to you, Terry, on developments in the economy at large. I know, there's a couple paths here, right? We have 97% of people are moderately to highly concerned about at least one of those 6 items. There might be others that would have brought us close to 100%. But as we look at this, there seems to be two potential outcomes, of course, or somewhere in the middle. One is a more bright future, like we expect interest rates to lower. You see that in the forward curve. But there's also storm clouds as levels of bankruptcies have shot up higher than some of the early COVID days. There's quite a bit of talk by different economists about a moderate or more significant recession. How is this factoring in or bothering the markets generally, and how should we be thinking about this?
I think a lot of it is a question of time frame. If you are focused on the next 2 or 3 months and you're a trader, which those two go together, then I suppose you've got a lot to worry about in a whole range of potential outcomes. If you're a corporate, hopefully you can look a little bit further out. You got to plan your liquidity in the near term, of course, but ultimately we're going to come out of all this and we're going to go, back to a growth stance, right? I think the market today has begun to price in another Fed increase. You can really see it in 1 and 3 month SOFR rates over the past several weeks. There was a period where rates were down on the SVB news, and then they sort of went back up to where they had formerly peaked, and then they were flat there for a couple of weeks, and the last couple of weeks we're back up again. I don't know if that's June or if it's July, but probably one or the other. And then the market is now finally pricing in more or less flat through the end of the year, and then maybe some cuts next year. That seems like a reasonable view to me. It is interesting, as usual, to see how quickly market sentiment changes, from notably in one direction to notably in the other direction.
Caused by a few events happening in close time frame. Boaz, anything that you'd want to weigh in here on the economy at large, for either agreeing or disagreeing with Terry, or adding some different color to it?
So I always agree with Terry because he's my capital provider. So it would be foolish. It would be foolish to take a different approach. But I think, no pun intended. But Terry, I agree. It depends on your time horizon. If you are looking short term, there will be additional adjustments. We've been through a pretty material, drastic change on many variables. They took place in a terribly short period of time, 12 to 18 months. It's a very short period of time. And I think the ripple effect will continue to be a level of uncertainty and concerns. But I think sooner than everybody expect or realize, we're going to go back to a normality. And maybe 2 or 3 quarters out, we may be now flirting with a mild recession. I think the Fed is scratching their head whether bringing us to a mild recession by bringing interest rates up 1 or 2 times more to feel more comfortable, whether it's a smart strategy, the right strategy. But I'm optimistic about the future. I thought that zero interest rate environment is an unhealthy environment. I thought it was just unsustainable. This irrational exuberance could not last forever. So in a funny way, I think we are much better off returning to a new normal. Even it will take a little bit time, a little bit concern, and a little bit stress, whether we're going to be again, at recession, mild recession, or the like. But I think overall, entering into 2024, everybody will be in a much better shape, will feel better, will have better visibility moving forward.
Two more things have popped up through the chat windows. The question is the housing market going to go through another crash? Maybe we could say, to what extent do we see the housing market impacting the overall economy? And then the second one is a question about China's economic recovery, current taking a low momentum, like slowly growing. Could this be a factor from a macroeconomic outlook perspective? I think the first one is certainly a concern. The second one is weighing heavily, and that seems to be one of the big inputs into the overall economic recovery, or maybe a dip into a global recession. Any comments on those areas from a broader feedback perspective?
I mean, I'll touch a little bit on just the housing market. Obviously, I think a lot of us have the fears of 2008 in our head, since it really wasn't all that long ago, and it's something we lived through. But I do think, that was tied to a specific issue with obviously the credit default swaps and all the risky items that banks were taking on. So again, I'm not an economist. I can't predict the future. But I don't foresee a housing crash like we had in 2008. I think we're a little more the economy's even shown a little bit of resilience throughout everything that's going on. I mean, we saw the poll questions of all the concerns, and the economy's been somewhat resilient to all those things. So as far as the housing market, maybe some things will slow. Obviously, when rates were near zero, 2 years ago, people were just scooping up items like crazy. It was just nuts. Everyone was just paying cash for, whatever. But I just don't foresee, the 2008 crash to where it's going to have that significant impact across the entire economy. So that's just my 2 cents.
If you'd told me 15 months ago that mortgage rates and other rates would be where they are today, I would have forecast that the housing market would be a whole lot worse right now than it actually is. It sort of blows my mind. And as somebody said in the chat box there's not enough inventory out there. Some of these things are self-reinforcing, right? The higher rates are making it so that it's tough for somebody to move. And so they're staying where they are, and that reduces the inventory and so forth. So I am not going to try to forecast the housing market. We do, as a provider of capital, we pay a lot of attention to it, and and what our clients and their customers' exposures are to that market, and indicators have been remarkably strong so far.
And just adding to that point about housing, which I think is a key factor to consider when you assess the macroeconomy environment, the micro environment globally, in the US especially. Most buyers have managed to lock over the last who knows how long extremely low interest rates. So the carry cost, their abilities to keep current and not default is extremely high, because the cost of borrowing was extremely low. It's almost like musical chair. The last person may have a problem. Those that have not bought yet primary or additional properties, depends on the situation, and have not been able to lock interest rates up until 18 months ago. Again, like musical chair, unfortunately, the last one will suffer, and I think that's the pain point that we see. But overall, I think for 90% of borrowers and owners of residents, or whether it's a single family or apartment condos, I think the cash flow and the budget look pretty healthy, just because of the very, very low borrowing cost, and that's a major stabilizing force over the housing market.
All right. Before we shift to the next section, I'm going to spring a surprise on them. We'll do a rapid speed round. You have 15 seconds to respond. You got to say your answer, and then a short reason for your answer if you'd like to. We'll start with, we'll go ahead and start with you, Boaz, then Ken, and then Terry, and we'll reverse the second question this way. So Fed fund rate rises in the next 2 periods, June, July. Will Fed funds increase 0%, 25 basis points, or 50 basis points? over the next two periods? Go.
I would say 25 basis points.
Okay. All right. You can give reasons if you want, but let's go to.
I will tell you my reason is just a guess.
Okay, perfect. Ken?
I'm going to agree with 25 basis points. And I say that because I think you're starting to see inflation slow a little bit. And I think the Fed's aware of, the greater risk in the economy. And so I think that'll be kind of their last ditch effort, and they'll stop it there.
All right, Terry, your pick.
I'll go for 25 as well and be a little more specific and say I think they may not move in June, but they'll do it in July. You asked about the two periods. And I agree with what Ken said. I guess what I would add is my guess is the Fed is more worried about not raising enough than raising too much still. Now that can change. We have a lot more agony in the bank market perhaps, but in the meantime, it's beat inflation first.
Okay, we're going to reverse the order. People, the second question is on the global economy. Will there be a global recession in any quarter in 2023? I guess it's two quarters. Where there's a dip in economic income. Well, let's just say one quarter where the GDP, the global GDP, has declined. Any quarter, so second quarter, third quarter, fourth quarter. Go ahead, Terry.
I'm going to say no, and I like that word that Ken used, as I've liked many of his words so far, resilience. It just, the U.S. economy, the global economy, they seem to take a beating and keep on ticking.
Okay. All right, Ken, you're up next.
Yeah, I mean, I'll agree. And now I'll echo Terry's words. Same reasons. I don't think we'll see that.
And Boaz, are you going to follow the crowd, or are you going to set out on your own?
No, I will set up on my own. I say there is a probably decent chance, with all the disclaimers, probably decent chance for a mild global downturn that will probably hit somewhere Q4 23, Q1 24.
All right, I like the specificity. I should have thrown in a few more of these. And thanks for dealing with no alerts on these. So we're going to shift to our fourth and final major section. This is levers to manage liquidity. We talked in the beginning about how visibility is helpful in seeing what goes on, because the sooner we see things, the more there's time to act. Levers are, if we use that term, is what can help us move and change what's going on. So what are some of the levers you and your trading partners are using or expanding their use of or planning to use? We're talking about liquidity management, supply chain finances is definitely part of the topic here. So Ken, maybe you could start us off on this one, and then and Terry, I mean, you deal with so many companies, maybe you could respond there after Ken's comments.
Sure. I'll talk about a few things that we do. So one of the most important ones that I'm sure a lot of companies use is just some sort of asset-based lending arrangement, right? So we're lucky that we partner with LSQ, where we have a factoring line on our receivables. So we're able to borrow a percentage of our receivables up front. So not only does that provide short-term liquidity necessary to operate our business, but it helps us project and smooth out our cash flows rather than continually guessing on when cash is going to come in the door. So that's one way that we manage it. So another way, and I alluded to this earlier, is really relationships. I mean, the world is still all about people. So you have your relationships with your customers and your lenders. So one of the things that we do is, as we talk with customers, and if we're taking on larger projects, or maybe they're a little bit riskier customer, we'll ask for a down payment, maybe just, something to get them to share in the risk that we're taking when we're financing these, large scale projects where we have to outlay a lot of cash up front. And then on the flip side, continue to talk with your lenders. I alluded to our relationship with LSQ. I speak with our account manager at LSQ at least weekly, sometimes daily. It really just depends, but I never want them to be surprised on where we're at or issues we're having, because not only do I want them to help us solve those issues, But also, I know an issue that we have could potentially cause, effects, across their business and their other customers as well. So I'm hoping that their other customers are doing the same with them, and that, communication is key across the board. Something else that we do is we really look into the margins of all of our different projects in our divisions. So, maybe 2 years ago when margins were good and you had some excess cash, the immediate answer was take that cash and reinvest it back in your business, or, go buy the next piece of equipment you need. But, maybe now with times a little bit uncertain, maybe it'd be prudent to store away some of that cash and strengthen your balance sheet just a touch. So, you have a reserve to tap into when, maybe you're stretched on your line, or, things are just getting tight. And so then, lastly, Terry alluded to the fact that we were seeing a lot of cash leave traditional deposits and go into, money market accounts or interest generating accounts. So, if you do have a borrowing arrangement and your interest rate is higher than you would like, and that's eating into your cash, you can kind of do two things. So you can, stash some of your reserves away in a interest generating account when you'll never make up the interest expense, but it will help offset some of that expense. But you can also look into some more complex financial instruments, credit rate, interest rate swaps, derivatives, any of those hedges that can help kind of alleviate some of the cost of capital that we're all experiencing right now. So those are really some of the ways that we look into, managing our liquidity and, some of the levers that we pull to try and get through the uncertain times.
Interesting. Piling up cash, good communication with your creditor, and taking down payments sounded similar to what Boaz was talking about, people wanting deposits. You just referred to them as down payments. He refers to their customers as a way of reducing the risk, but sharing and spreading out the cost of that capital. There's different ways of doing that. Terry, I know you talk to lots of different companies as a lender. What are some of the highlights you'd want to bring forth to this discussion?
Sure. Well, as I mentioned earlier, we're fundamentally in the business of helping buyers have longer terms or suppliers have shorter terms without undue pain to the other side of that transaction. There are lots of different structures for doing that. We can do it in different ways. And I would say there is a real theme both of buyers looking to lengthen their terms and soften the blow to their suppliers by offering a supply chain finance program for early payment, or simply to implement a supply chain finance program to bring the liquidity and financial strength and credit quality of the buyer to their entire supply chain ecosystem, if you will. A small supplier may have a harder time finding liquidity than a large buyer. And so the large buyer may choose to use some of that liquidity to bring it to their supply chain for, let's call it sustainability purposes, but I don't mean in a DEI or ESG way. I mean, literally that the suppliers will be there when the buyer needs them.
Yeah, that seems very, very much what we saw back in the early days of COVID. Everyone was tightening, slowing down their payments. But there were some companies that were in a financial position where they paid their suppliers earlier. They were pushing there to make sure that they would be able to be sustained, or the distributors. They offered different types of terms to essentially finance them to keep them going. So some different responses in the time of the seas are a bit rougher, not this unending liquidity. We can have more comments on this, but I want to have Brian pop up the final poll question. This is the third one. Regarding the status of our capabilities, we currently have visibility to all of our cash globally on a daily basis, visibility to some or all of the cash conversion cycle, so AP, AR, whatever the flow is, good forecasting analysis on our cash flow. In other words, we have good analysis and we use multiple models, not just we have a good forecast. And we have levers we can use for liquidity management for AP or AR, such as what's been discussed here, or none of the above. I'm really interested to see where people are. This is a group that's talking about liquidity management. How advanced is the audience today? And again, we certainly got more than the 150 responses we need in the chat box, which is great. And so everybody will get those poll responses. We have a couple other questions that have come in. I don't know that we're going to be able to take those, but while we're waiting for the poll responses, any other comments about levers? Boaz or Ken, anything else that you guys might have wanted to add to that discussion?
I'll just add one more thing, and it's kind of a mix of some things that have already been said, but I think if you're in a business where your margins are really good and strong, I think you have the opportunity to use that as leverage with some of your customers to say, we can maybe reduce some of that margin and be a little bit cheaper, but we're going to need, quicker, faster payment terms or some cash up front. And so, I think you need to take a deep dive into your business and see where you can potentially eat into some of your margin if you need to. You may not need to, but I think if you need to, that's a potentially good route to take.
Thanks for that. Boaz, anything?
I think relationship is key. I think that maybe rethinking the number of suppliers or customers. Maybe it makes sense, instead of having a large quantity on both sides, maybe reducing and focusing will help. You may lose some of the margins, but you may be working with better suppliers, with better customers in terms of your product and fit, and that will allow the business. So maybe getting rid of some of the back noise. Maybe the cost will be some short-term decrease in marginal revenues, but I think it refocusing on key relationship, key customers, key suppliers may be a great strategy.
All right, so we have the responses back on the capabilities. Well, it does trend down from 60% global cash visibility, 63%. Good forecast and multiple flows, 51% is number 2. Pretty impressive. Pretty impressive number there. And then visibility on the cash conversion cycle, 45%, and 40% have some levers they can use. So Terry, I'm sure that's good news for you that there's still even on a discussion about this, there's still 60% of the audience isn't using the levers. They're seeing what goes on, but not able to use the lever. So anyway, thanks everyone for answering the poll questions that we have. Now this brings us, we're closing in on our hour. We want to make sure we get everybody off to their next meeting on time. But we're going to go we're going to go Boaz, Ken, and Terry. Love to hear your final thoughts. It could be something you've said or something you wanted to say. What wisdom, guidance, or advice would you give to your peers? It could be something to avoid or something to do. Boaz.
So unfortunately, I will repeat myself, and I think that the new normal is not a bad thing. It takes time, a little bit time to readjust, and but I think overall on the other side of that process, we're all going to be in a much better shape, feeling more comfortable and more optimistic. I think that refocusing on our strength, refocusing on product lines, suppliers, customers that add the vast majority of margins and make sense, and maybe clean up everything else just for the time being, and then we can reassess 12 to 18 months from now. I am optimistic getting into 2024, and that's about it.
Okay, thanks, Boaz. Ken.
Yeah, so I'll echo kind of what Boaz said, and then also add just on some things I've already hit that, I think if we all, make sure that we really understand our business, are in tune with our customers, our suppliers, our lenders, and really just continue our relationships and make sure, again, communication is key with all your stakeholders. Obviously this, as Boaz said, this is the new normal, and, these times will end, and, we'll get back into the growth phase, hopefully sooner rather than later. But I think, we can all continue to ride out the little bit of uncertainty, as long as, your relationships are strong with all your stakeholders.
Thank you also, Ken. And Terry, your final comments.
Sure. I'll just talk my own book and say, in these days of less available capital and more expensive capital, have a think about your working capital strategy and what you're doing with your receivables and payables and ways that you might be able to generate liquidity more cheaply than you think, and without amendments and fees and covenants and new credit approvals and reporting to banks quarterly and all that sort of thing. We have some interesting solutions we'd love to share.
Great. Thanks to each of you. Great job on the panel discussion. I know there's a number of questions that came through that we didn't get to, particularly on the economic side, and some prognostications about some different markets. So thanks for submitting those. We always try to cover as many as we can. As we move to Brian doing a closeout and references, I think we're also posting some links in the box for following companies. Connecting on LinkedIn, would love to do so. So I'll turn it back over to Brian, and thank you, everyone. Brian.
Well, indeed, thank you, gentlemen, and thank you, everyone, for joining us today. The CTP and FP&A credits. A recording of today's webinar will be sent to you within 5 business days. And for more on levers for liquidity, be sure to listen to the Treasury Update podcast, episode 250 with LSQ, titled Working Capital, Thriving in Uncertain Times, by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.